When it comes to the most successful traders, Ross Cameron undoubtedly stands out. As of April 2024, he has impressively grown an initial account of just $583 to a staggering $10.92 million. These results are real, fully verified, and audited. With this incredible achievement, he has garnered the attention of over 1.2 million followers. When asked if he could turn a few $100s into 10 million again, Cameron said the hardest part of the small account challenge is reaching the first milestone of $10,000. After that, it's just a matter of time. He often demonstrates small account challenges live, and in his hands, small accounts consistently double or even grow exponentially. For example, this March, he turned a $600 account into $16,013 in just 20 days. It's clear that his $10 million success wasn't just luck. He has a specific and highly effective strategy for consistently profiting in the market. Hello, welcome to the Speculation Lab. Cameron employs a high-probability momentum strategy focused on capturing large market swings. While this approach carries high risks and rewards initially, it quickly becomes much safer as he establishes a safety buffer, significantly reducing overall account risk and making it more stable. His results may be difficult to replicate, but the strategy itself is definitely worth learning from. And now, I'm about to reveal every detail of it to you. The first step in executing the strategy is to find trading assets that align with it. This is the simplest way to reduce trading risk. The choice of assets depends on the type of strategy, and momentum strategies work best with assets that have strong upward momentum. For example, during his small account challenge in March, Cameron started with $600 and made $125 on the first day. By the end of the first week, his account had already doubled. He attributed this rapid growth to consistently identifying assets that could gain 30%, 40%, or even 50% in a single day. In contrast, companies like Meta, Google, or Netflix are too large for this kind of rapid movement. It's almost impossible for them to see a 20% increase in just 1 or 2 days. Assets with strong upward momentum typically share 5 key characteristics. First, the day's price increase is already over 10%. These assets have established momentum, making it much more likely for them to gain another 10% or more. Second, they rank in the top 5 on the day's gainers list. Top-ranked assets tend to attract the most market attention and trading volume. This concentration not only boosts liquidity but also makes their chart patterns more reliable and easier for traders to follow. Third, the asset must have a high relative trading volume. Relative trading volume measures today's trading volume against the stock's average daily volume. For instance, if a stock typically trades 150,000 shares per day but hits 1.5 million shares today, its relative volume ratio is 10x. This rapid surge in trading activity is a critical driver for assets to achieve a swift price increase of 10% or more in a short period. Fourth, the price should be under $20, especially during the first week of implementing the strategy. Ideally, assets priced below $10 are the best choices, and the cheaper, the better. Low-priced assets are more likely to experience significant percentage gains. For example, a 100% increase from $1 to $2 is much more achievable and common than a jump from $20 to $40. Fifth, the asset should have low float. Float reflects the imbalance between market supply and demand. The essence of rapid price increases lies in overwhelming demand with a limited supply of tradable shares. Take the stock Lucy as an example. It has only 11.24 million shares in float, yet its single-day trading volume reached 944 million shares. This extreme supply-demand imbalance drove its price up by 428% in just 1 day, securing the top spot on the gainers list. These are the kinds of assets we aim to find daily, those with the strongest short-term momentum. Assets that meet the above 5 criteria tend to have exceptionally strong momentum. If they are further backed by impactful news, the probability of a 30% or greater price surge in a single day becomes significantly higher. In markets driven by greed, these strong-performing assets can quickly generate profits and help establish a safety buffer. Momentum trading, at its core, is about capturing opportunities arising from breaking news. This could include unexpected financial anomalies, overlooked investment opportunities, or major events such as mergers, significant contracts, management changes, or legal disputes. Similarly, in the crypto space, events like ETF applications, interest rate cuts, or related announcements can trigger strong price reactions. The actual impact of news needs to be carefully assessed. Some news events may only affect the market for a few hours, while others can influence prices for days or even weeks. During breaking news or periods of heightened volatility, an asset's price often deviates significantly from its true value, leading to large price swings. When trading with leverage, even low leverage can result in a blown account from a single misstep in such conditions. This makes establishing a safety buffer especially critical for small accounts. It's a crucial phase that cannot be skipped. These selection criteria are not arbitrary but are based on Cameron's extensive data from tens of thousands of trades. The assets fitting these criteria have consistently been his most profitable opportunities. Once the selection criteria are met, the next step is chart analysis. Start by opening a 5-minute chart to observe the price action and determine whether the asset is in a pullback, at a low point, or has already broken through a key level. Next, switch to the daily chart to assess the asset's position and context within the broader market. Confirm whether the overall trend remains intact and identify potential key support and resistance levels, as well as significant highs and lows. These critical levels not only guide entry points but also provide the basis for setting take-profit and stop-loss levels. Once your strategy is set, it's essential to execute it with discipline, avoiding any ambiguity or impulsive adjustments. Another key indicator for assessing trends and support resistance levels is the EMA 200, which is one of the most effective tools on the daily chart. When the price is below the EMA 200, the first couple of attempts to reach this level often face significant resistance. Breaking above it typically requires substantial trading volume. It's generally better to buy after the price breaks above the EMA 200 and holds above a key resistance level. However, if the price hasn't yet broken the resistance but is at a reasonable distance from it, and the risk-reward ratio is at least 2-to-1, an entry can also be considered. Sometimes, he enters trades on the 5-minute or 1-minute chart when the price revisits a key level for the first or second time. He also trades pennant and flag breakouts. While these patterns are simple, they are often highly effective. The core of the strategy doesn't lie in complex models but in identifying high-quality assets in a greedy market. The key to success is choosing the right assets, not obsessing over perfect chart patterns. Even if the chart setup isn't flawless, high-quality assets are still more likely to deliver strong trading results. Alright, don't forget to hit the subscribe button to stay updated with more profitable trading contents. I wish you a good morning, good afternoon, and good evening. Goodbye.